The world watches with bated breath as Japan takes significant steps away from the US dollar, a move that could reshape the global financial landscape. This move, while seemingly technical, has sent ripples through the global financial system, causing analysts and investors to rethink their strategies. For decades, the US dollar has reigned supreme as the world's reserve currency, a position that has afforded the United States immense power. This dominance has given the United States unparalleled economic and geopolitical leverage, influencing global trade and finance. However, recent events suggest that this dominance is being challenged, as countries like Japan seek alternatives. Japan, a major economic powerhouse, has signaled its intent to diversify its foreign exchange reserves, moving away from an over-reliance on the dollar. This decision comes amidst growing concerns about the stability of the US dollar, which has been under pressure due to various economic challenges. Former President Trump's economic policies, including trade wars and tariffs, have created uncertainty in global markets, adding to the volatility. His accusations of currency manipulation against China and Japan have further strained relations, complicating international trade dynamics. Japan's move away from the dollar is a clear indication of waning confidence in the US economy, reflecting broader global sentiments. It reflects a broader trend of countries seeking to reduce their dependence on the dollar, diversifying their reserves to mitigate risks. This shift has significant implications for the future of global trade, finance, and geopolitics, potentially altering the balance of economic power. The US stock market, a barometer of investor sentiment, has reacted nervously to Japan's decision. News of Japan's move, coupled with ongoing trade tensions and global economic uncertainty, has triggered a sell-off in the stock market. The Dow Jones Industrial Average, a key indicator of US stock market performance, has experienced a significant decline. The $1.7 trillion loss in the US stock market, while disputed by some, reflects the nervousness gripping investors. This figure, if accurate, represents a significant blow to the US economy. It underscores the interconnectedness of global markets and the potential fallout from policy decisions made in Washington. Former President Trump's penchant for tariffs has further complicated the situation. His administration imposed tariffs on goods from China, Mexico, Canada, and other countries. These tariffs, intended to protect American jobs and reduce the trade deficit, have had the opposite effect. They have disrupted global supply chains, raised prices for consumers, and hurt businesses that rely on imports. The tariffs have also drawn retaliation from trading partners, leading to a tit-for-tat trade war. This trade war has created uncertainty and volatility in global markets, making businesses and investors wary. The tariffs, coupled with Japan's move away from the dollar, have cast a shadow over the global economic outlook. Adding fuel to the fire are accusations of currency manipulation. Former President Trump repeatedly accused China and Japan of artificially devaluing their currencies to gain a trade advantage. These accusations, while denied by both countries, have strained relations and heightened tensions. China, in particular, has been in the crosshairs of the Trump administration's trade policies. The US has accused China of unfair trade practices, intellectual property theft, and forced technology transfer. These accusations have led to a trade war between the world's two largest economies, with tariffs imposed on billions of dollars worth of goods. Japan, while not facing the same level of scrutiny as China, has also been criticized for its monetary policies. The Bank of Japan's decision to maintain low interest rates, aimed at stimulating economic growth, has been seen by some as a form of currency manipulation. Section 5. Shifting Sands. Geopolitical implications of a weakening dollar. As the global economic landscape evolves, the weakening of the US dollar has profound implications that ripple across continents and economies. The geopolitical implications of Japan's decision are far-reaching. Japan, a key ally of the United States, is now navigating a complex economic environment. Its decisions could influence regional stability and economic policies in neighboring countries. A weaker dollar diminishes the United States' influence on the world stage. This shift could lead to a rebalancing of power, affecting international trade agreements and diplomatic relations. It also emboldens rivals like China, which has been actively promoting its own currency, the yuan, as an alternative to the dollar. China's strategic moves are aimed at reducing its dependency on the US dollar and increasing its own economic sovereignty. China's Belt and Road Initiative, a massive infrastructure project spanning Asia, Europe, and Africa, is seen by many as a way for China to expand its economic and political influence. This initiative not only strengthens China's ties with participating countries, but also promotes the yuan in global markets. The initiative, which involves billions of dollars in investments, could further accelerate the use of the yuan in international trade and finance. As more countries engage with China through these projects, the yuan's role in the global economy is likely to grow. Russia, another country at odds with the United States, has also been taking steps to reduce its reliance on the dollar. By diversifying its economic partnerships and exploring new markets, Russia aims to mitigate the impact of U.S. economic policies. The Kremlin has been accumulating gold reserves and encouraging the use of the ruble in international transactions. This strategy is part of a broader effort to stabilize its economy and assert greater control over its financial future. These moves are part of a broader effort by Russia to shield itself from Western sanctions and assert its economic independence. By reducing its reliance on the dollar, Russia aims to create a more resilient and self-sufficient economy, capable of withstanding external pressures. Section 6. The allure of the yen, a safe haven in uncertain times. Amidst this global uncertainty, the Japanese yen is emerging as a safe haven currency. Investors seeking stability and security are flocking to the yen as a hedge against risk. The yen's reputation as a safe haven stems from Japan's strong economy, stable political system, and large current account surplus. The yen's rise comes at a time when trust in the US dollar is waning. Former President Trump's unpredictable policies, coupled with growing concerns about the US economy, have made investors wary of holding dollar-denominated assets. The yen's safe haven status is likely to be reinforced as long as global uncertainty persists. Section 7. A world beyond the dollar, de-dollarization gains momentum. Japan's move away from the dollar is part of a broader trend of de-dollarization. This shift is not just about diversifying reserves, but also about gaining more financial independence and stability in a volatile global market. Countries around the world, disillusioned with the dollar's dominance and wary of U.S. economic policies, are seeking to reduce their dependence on the greenback. This movement is driven by a desire to mitigate risks associated with the dollar's fluctuations and the geopolitical leverage it grants the United States. This trend has been accelerated by the increasing use of sanctions by the United States. Sanctions have become a powerful tool in U.S. foreign policy, but they also create uncertainty for countries holding large amounts of dollar-denominated assets. The freezing of Russia's dollar reserves following its invasion of Ukraine sent shockwaves through the global financial system. This unprecedented move underscored the vulnerability of nations to U.S. financial influence and prompted a re-evaluation of reserve strategies. It highlighted the risks associated with holding dollar-denominated assets and prompted countries to explore alternative reserve currencies. Nations are now more actively seeking to diversify their reserves to include other major currencies like the euro, yen, and even gold. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been at the forefront of this de-dollarization drive. These countries are leveraging their collective economic power to create a more balanced and multipolar financial world. They have established their own development bank, the New Development Bank, as an alternative to the World Bank and the International Monetary Fund. This institution aims to provide financial support for development projects within BRICS and other emerging economies. The BRICS nations have also been promoting the use of their own currencies in bilateral trade and investment. By doing so, they aim to reduce transaction costs, minimize exchange rate risks, and strengthen economic ties within the group. Section 8. The future of global finance. Navigating a multipolar currency system. The world is moving towards a multipolar currency system, where the dollar shares the stage with other major currencies like the euro, the yuan, and the yen. This transition, while gradual, will have profound implications for the global economy. It will reduce the United States' economic and geopolitical leverage while empowering other countries. A multipolar currency system will also make the global financial system more complex and potentially less stable. Exchange rates will be more volatile, making international trade and investment riskier. Countries will need to navigate this new reality carefully, hedging their bets and diversifying their foreign exchange reserves. Section 9. Conclusion: a new economic order in the making? Japan's decision to reduce its reliance on the US dollar is a watershed moment in the evolution of the global financial system. It signals the end of the dollar's unipolar moment and the emergence of a more multipolar currency order. This shift has been driven by a confluence of factors including US economic policies, geopolitical tensions, and the growing clout of emerging economies. The world is entering a new era of economic uncertainty and opportunity. The rules of the game are changing, and countries that adapt quickly will be best positioned to thrive in this new environment. The future of global finance is in flux, and the stakes are high for everyone involved.